Today's lecture will be on Chapter 26. What type of form of a business organization should you choose? As you can see from this slide, there's many ways that you can form your business. The majority of this chapter will focus on the ones that are at the top three: sole proprietorship, partnerships, and corporations. In fact, the similarities and differences between those will be the basis of your third essay question on your final exam. Afterwards, we'll briefly talk about limited liability companies, limited liability partnerships, and franchises. A sole proprietorship, as the name implies, is a business that's owned and usually operated by one person. Thus, the sole proprietorship is an extension of its individual owner. The owner still may have employees, and the business may have a different name than the owner. However, the owner has all the responsibility, which means he or she gets to keep the profits, and he or she is responsible for all of the losses. In essence, the sole proprietor has unlimited personal liability, which means if the business goes down and the business can't pay for any of the creditors or debts of the company, the sole proprietor has to cough up from his or her personal assets, which could be his or her house, his or her automobiles, etc. That's unlimited personal liability. The second type of way to form a business is known as a partnership. And a partnership is a voluntary association of two or more people designed to carry on a business for a profit. The default type of partnership is known as a general partnership. In a general partnership, there is only one type of partner, known as a general partner. All general partners have unlimited personal liability, which means just like with the sole proprietor, any liabilities of the partnership may become the liabilities personally of each individual general partner. So general partners have equal management and control. However, they all have unlimited personal liability. Notice that no express agreement is required for a general partnership, and you don't have to file at all. The other type of partnership is known as a limited partnership. Now the slide says LLLP. I want you to substitute that simply with LP. A limited partnership has two different types of partners: at least one general partner and at least one limited partner. The general partner has all the management and control, but the general partners as well have unlimited personal liability. Limited partners in a limited partnership have limited management and control. However, what they lose in power and control, they gain the notion of the limited liability, which means a limited partner's losses are limited to what they've invested in the partnership. You can't go after the limited partner's personal assets if the partnership were to fail. The third type of entity I want to look at is known as a corporation. And a corporation is an entity that is separate and distinct from its actual owners. So corporations may acquire, hold, or convey property in their own name. They can be sued and be sued. And there are generally two main types of corporations. Ones that you're probably very familiar with are known as publicly held corporations. Here, all corporations issue shares. In a publicly held corporation, the shares of ownership are sold on the open market to investors. They have little interest in managing. So for instance, I own shares in lots of publicly held corporations. I am not a manager and I have very little control. It's completely different with the second type of corporation, a close corporation. Here, stock is owned by family members or people who know each other, and thus, since it's closely held, shares are not actively traded on the open market. Owners or shareholders of closely held corporations do have management and control. One of the beautiful things about corporations is that its owners have limited liability. Remember that a corporation is separate and distinct from the actual owners. So if any problems happen to the corporation, you can't go after the shareholders' personal assets because they have limited liability. the basis of your third essay question on your final exam is to look at the relevant factors in choosing a business structure for a sole proprietorship, a partnership, whether general partnership or limited partnership, and a corporation. And we're going to look at the following 7 factors, and you need to compare and contrast these factors between those types of entities that I just mentioned. The first one is limited liability, and it's probably one of the most important things to consider when choosing which form of business to organize. As already mentioned, both sole proprietors as well as general partners in a general partnership and general partners in a limited partnership have unlimited personal liability, which means if the business goes down after exhausting all the business's assets, you can go after the assets of the individual owner. Limited partners and limited partnerships and shareholders and corporations have limited liability. Sometimes there is an exception talking about piercing the corporate veil, but I don't want you to be responsible for that for your essay question. The second factor to look at is taxation, and usually the investment decision will be greatly affected by tax laws. Corporations are a separate entity, and thus corporations are subject to corporate income tax. In addition, corporations may be subject to double taxation to the extent that they pay dividends from their profits to their shareholders or their owners. So in essence, the same amount of profit can be taxed once at the corporate level and taxed a second time at the individual or shareholder level to the extent that the corporation declares a dividend or payout from its profits to its owners. Another type of corporation known as an S corporation is an exception, and usually those are corporations with 100 or less distinct shareholders. They are taxed more like a partnership or a sole proprietorship. And how are sole proprietorships and partnerships taxed? They aren't taxed. They're known as pass-through entities, and thus the business of the sole proprietorship and the business of the partnership do not pay income tax. Profits are passed through to their owners, and the owners pay the profits on their individual income tax returns. Third, formalities. Well, for sole proprietorships and partnerships, for sole proprietorships and for general partnerships may be formed and terminated with fewer formal requirements. You don't have to do much with the state or paperwork, etc. However, corporations and limited partnerships must file articles of incorporation and comply with regulations. Why do limited partners have to file with the state but general partnerships do not? Limited partnerships must file with the state because you need to at least announce to people who want to do business with you that certain partners only have limited liability. The fourth and fifth factors can be found on this slide. Fourth, financing. It's much easier to finance a corporation because corporations can oftentimes secure financing more easily, such as issuing more shares of stock or issuing what's known as debt, which is non-ownership. It's much tougher for a sole proprietorship because there's only one owner financing the business. With a partnership, it may be easier depending on how many partners there are in the partnership. Management is much easier for the sole proprietorship because there's only one owner. He or she gets to make all the management decisions. With a general partnership, all the general partners have equal management and control. With a limited partnership, as you know, the general partners have the management and control and the limited partners do not. Finally, with a corporation, generally speaking, for publicly held corporations, owners have little, if any, management and control besides voting for the shareholders and voting to amend the articles of incorporation. However, in private or closely held corporations, the shareholders oftentimes have very, very good management and control because there's only a few shareholders and they effectively are running the business on their own. How long will the business last? Well, if it's a sole proprietorship, it'll last as long as the sole proprietor decides to run the business for. Once the sole proprietor dies, the business usually dies with it, unless it's inherited on. With a partnership, it's going to depend what's in a partnership agreement. So, depending on what's written in the partnership agreement, will decide how the partnership will go on if one or more partners leaves the partnership. Although if there are two partners and one leaves, it's no longer a partnership because with a partnership, you got to have at least two or more. Finally, with a corporation, usually if it's a publicly held corporation, it'll go on, and it doesn't matter if a owner or shareholder leaves. If I sell my shares of Apple, the business will go on. For a closely held corporation, that might be different. Let's look at how to get out an investment. One of the things I like about being a shareholder of a publicly held corporation, it's easy for me to get in and out of a ownership position. I can just go to my brokerage account, hit the buy button if I want to buy in, or the sell button if I want to get out, and it's very easy to do so. It's tougher with a closely held corporation. There may be covenants not to sell your shares of stock. Well, same thing with a partnership. There may be terms in the partnership agreement that may make it easier or tougher to get out of the partnership. Finally, a sole proprietorship, you have to be able to sell the business in order to be able to get out of it, and it may be very difficult to do. So for your third essay question, you definitely need to compare and contrast the various 7 factors that I brought up with regards to sole proprietorships, general and limited partnerships, and corporations, whether closely held or publicly held. Finally, I want to talk a little bit about limited liability companies, franchises, and limited partnerships. First, limited liability companies, or LLCs. They are known as limited liability companies as opposed to limited liability corporations. An LLC is not a corporation. LLCs don't have shareholders, they have members because LLCs do not issue shares. LLCs enjoy the tax benefits of partnerships, however, and the limited liabilities of corporations, which means usually they're only taxed once, like a partnership or sole proprietorship. However, its members enjoy limited liability, just like shareholders of corporations. Limited partnerships, or a limited liability partnership, LLP, is a type of general partnership. So again, a limited liability partnership is a type of general partnership. As we know about general partnerships, they only have one type of partner, they're general partners. But the beauty of an LLP is that in a limited liability partnership, all the general partners have limited liability as opposed to unlimited personal liability. So again, on this slide, I want you to change the title of the slide to limited liability partnerships. And so I don't know why today you would ever form a general partnership when you can form a limited liability partnership, because a limited liability partnership has one type of partner, a general partner, but they all get limited liability. Finally, I want to talk just briefly about franchises. Franchises have gained in popularity in recent years. Instead of opening up your own business like Dave's Pizza, you may want to open up a Domino's Pizza franchise. So, how does a franchise work? Well, it starts with the franchise or the OR. He or she develops a product or service and outlets or brands out his or her idea or service. And so a franchising agreement is simply based on contract between the OR and the double E, the franchisor, and the franchisee, the person buying into the franchise. Benefits to being a franchisee in a franchise is that it combines the advantage of a small business with the larger franchisor that have more resources and more marketing impact. You have a brand name. So no one knows about Dave's Pizza, but you definitely know about Domino's Pizza. But there are many complaints about franchising. Franchisees often complain about the huge contract and often liken it to a contract of adhesion that we talked about before. So these contracts can often be thousands of pages in length, which severely restrict the right of the franchisee to run his or her franchise. So for instance, you may have to use certain products. You have to keep certain items on the menu. You got to have certain prices on the menu, etc. You really don't have a lot of management and control when you are a franchisee in a franchise. This concludes our lecture on Chapter 26, which form of business organization to choose when forming a business.